Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
Friday, January 30th, 2026. The closing bell rings on the NASDAQ and the ticker Shopify is flashing a number that, well, nobody wanted to see. $131.23. That is a sharp, brutal decline of 8.64% in a single 6.5-hour trading session. We're looking at a stock that started the day testing 141, looking to break out, and ended it by sweeping away weeks of accumulation.
And let's be very clear about the mechanics of that drop right out of the gate. This wasn't some low-volume drift on a slow Friday. This was institutional capitulation. 12.83 million shares changed hands on the NASDAQ alone. That is heavy, heavy volume. And, you can't look at this in a vacuum. This drop happened right alongside a broader tech rout, specifically triggered by warnings from major banks, JP Morgan included, that artificial intelligence is finally coming for the SaaS business model. The market is suddenly asking a, frankly, terrifying question. Is software as a service dead?
Which sets the stage perfectly for the argument we need to have right now. Is this 8% drop a panicked, emotional mispricing of Shopify's new agentic commerce infrastructure? Essentially, the market failing to understand the pivot, or is this a rational, maybe even belated correction for a company trading anywhere between 77 and 94 times forward earnings, while its own executives are hitting the sell button?
A 94 times multiple in this macro environment. That's not a pivot premium, that's a bubble looking for a pin. But okay, lay out the bull case first. Convince me that Friday was a mistake and not a much-needed wake-up call.
It was a mistake because the market is still pricing Shopify like a website builder. When the average trader hears SaaS disruption, they think of legacy tools. They see Shopify as the place you go to pick a template and upload photos. So they assume AI can now do that for free, and Shopify is toast. That view, it misses the entire point of the Winter 26 edition. Shopify isn't building websites anymore. They are building the operating system for the AI itself. The pivot to agentic commerce means Shopify is the infrastructure that allows AI agents to actually transact.
Agentic is the buzzword of the quarter. Every slide deck in Silicon Valley has the word agentic on it right now. What does it actually mean for the bottom line?
It means autonomy, and autonomy means efficiency. Look at the evolution of Sidekick. In 2024 and 2025, it was a chatbot. You asked it questions, it gave you answers. How were my sales yesterday? Cute, but not critical. The version released this week is a real operator. It builds custom apps, it edits themes using natural language, it automates B2B migrations. It literally does the work of 3 employees. This is the renovations they are pitching. And despite the red ink on Friday, the stock is still up 40% over the last year. They hold 29% of the U.S. e-commerce market share.
Right, but holding market share and holding a valuation are two very different things. You mentioned the 40% gain over the year. I just see that as altitude available to lose. Look at the technical damage done on January 30. We saw a bearish crossover. The 20-day moving average crossed below the longer-term trend lines. In technical analysis, that is the definition of momentum dying. It tells us that the short-term trend has violently decoupled from the long-term thesis.
Technicals can be self-fulfilling prophecy, sure. If enough algorithms see the crossover, they sell. But they aren't fundamentals. They don't tell you about the health of the actual business.
But they drive price, and they drive fear. And the options market is screaming danger. The 30-day implied volatility is sitting at 64.3%. For our listeners who don't trade options, implied volatility is essentially the market's price for insurance. When it hits 64%, which is in the 81st percentile rank, it means traders are paying a massive premium to protect themselves against a crash. They have no idea where the floor is.
Or they are paying a premium to capture the upside of a breakout. Volatility cuts both ways. You pay for insurance against a crash, but you also pay for call options if you think the earnings are going to blow the roof off.
Not when the valuation is this stretched. Let's do the comparative analysis, because I think this is where the SaaS is dead argument gets really tangible. Look at Adobe. Adobe is the gold standard for creative software. Market cap, $120 billion. Profitable, dominant, essential. Yet Adobe stock is down 34% over the last year. Why? Because the market is terrified that generative AI, Mid-Journey, Sora will replace Photoshop.
That's the narrative, yes.
So now look at Shopify. Market cap of $188 billion, significantly higher than Adobe. Yet until, 48 hours ago, the market treated Shopify as if it were immune to that same disruption. That gap is closing. The JP Morgan warning was clear. AI agents might bypass subscription software entirely. Why pay Shopify a monthly fee when an AI can code a storefront for free on an open-source platform?
I'm just not convinced by that line of reasoning because commerce is not the same as content creation. That comparison fails on the physics of the business. You can generate an image with AI, but you cannot generate a supply chain. You can't generate payment processing or fraud detection or tax compliance in 150 countries. That is the moat. And this leads us to the ecosystem argument. You think AI bypasses Shopify? I argue Shopify has embedded itself into the AI. Look at the Agentic Storefronts initiative.
Embedding or hiding?
Insulating. They have integrated the checkout flow directly into ChatGPT, Microsoft Copilot, and Google Gemini. Think about the user behavior shift. A user doesn't search Google for running shoes anymore. They ask Gemini, find me the best running shoes for flat feet under $100. The AI finds the product. If that product is on Shopify, the checkout happens right there in the chat window. Shopify isn't fighting the current. They built a hydroelectric dam to capture the energy.
That sounds elegant, but it commoditizes the merchant. If I'm buying through ChatGPT, I don't care about the brand's beautiful website. I care about the transaction. But let's look at a partnership that actually involves money changing hands right now. The AppLovin Peel.
A massive catalyst. This is the shiny object that actually has substance. AppLovin is an advertising powerhouse. Shopify just launched a one-click integration for their merchants. Bank of America, who, unlike JP Morgan, is very bullish, projects this could drive, $6.7 billion in total merchant ad spending by the end of 2026.
That's ad spend by the merchants, not revenue for Shopify.
It flows through the ecosystem. It increases gross merchandise volume. And more importantly, it solves the single biggest problem for direct-to-consumer brands, customer acquisition costs. Ads are too expensive. AppLovin uses AI to optimize that spend. If Shopify helps its merchants sell more cheaply, those merchants stay on the platform. It reduces churn. It makes the platform sticky.
I'll concede that AppLovin is a net positive. It's a smart move, but we have to address the 800-pound gorilla in the room, Amazon. You keep pointing to the Buy with Prime integration as a win. You cite the statistic that it increases conversion rates by 35%. Great. But at what cost?
The cost of a partnership. It's symbiotic. Amazon gets the volume, Shopify gets the transaction fee.
It's parasitic. When a Shopify merchant uses Buy with Prime, who owns the customer? Amazon. Who handles the fulfillment? Amazon. Who holds the credit card data? Amazon. Shopify is ceding the physical relationship, the logistics, the box arriving at the door, to their biggest competitor. They are retreating into the software layer. And if history has taught us anything, it's that being just the software layer is a precarious place to be when Amazon decides to squeeze your margins.
That is a fundamental misunderstanding of the hub and spoke strategy. Shopify has no interest in owning trucks and warehouses. They tried that. Remember Shopify Logistics? They sold it. That is a low-margin, capital-intensive nightmare. They want to own the data and the merchant interface. The multi-channel fulfillment app allows them to utilize Amazon's logistics without losing the merchant to Amazon's walled garden. It's a tactical maneuver to neutralize Amazon's biggest advantage, speed, while keeping the merchant paying that Shopify subscription.
It works until it doesn't. And speaking of just software, look at the peer group. Look at BigCommerce. 5 years ago, the debate was Shopify versus BigCommerce. It was the Pepsi versus Coke of e-commerce. Where are they now? BigCommerce has a market cap of $265 million. Not billion, million. They've collapsed. Their 5-year CAGR is negative. My point is being an e-commerce platform doesn't guarantee a $188 billion valuation.
If your insulation strategy fails and merchants realize they can sell directly through an AI agent without the Shopify tax, the repricing won't be 8%, it will be 50%.
Big commerce failed because they couldn't move up market. They got stuck with small businesses that go bankrupt. Shopify is winning the enterprise game, which we can get to. But I want to circle back to your repricing comment. You talked about the heavy volume on Friday. You called it capitulation. I call it a liquidity event. But there is more going on under the surface, isn't there?
Now we're getting to the good stuff. The things you don't see on a standard chart. We need to talk about market microstructure. If you pull up the public short interest data for Shopify right now, what do you see?
It looks incredibly benign. Roughly 0.91% of the float is sold short, less than 1%. If you only looked at that, you'd think the entire market was bullish.
Exactly. And that is the trap. That is the public short interest. Now look at the off-exchange data, the dark pools.
For clarity, these are private exchanges used by institutions to trade large blocks without immediately moving the public price.
Correct. And on January 13th, the off-exchange short volume ratio for Shopify spiked to 54.5%. For the week leading up to this crash, it averaged around 43%.
Which is high, but, could be standard hedging practice for a high beta stock.
A 54% spike is not standard hedging. That is aggressive positioning. When over half the volume in the dark pools is short selling, it means the smart money, the hedge funds, the institutional desks, are betting against the stock or hedging massive downside risk, all while the retail investor looks at the public data and thinks everything is fine. They are selling into the liquidity that retail provides. That divergence, low public shorts, massive dark pool shorts, is a classic warning sign of a correction. It's like the termite damage inside a wall. The paint looks fine, but the structure is rotting.
I interpret that differently. Dark pool short volume often includes market makers providing liquidity. It's not always a directional bet. But if you want to talk about institutional signals, let's look at hard ownership data, actual shares held. JP Morgan, the very bank you cited as warning about these SaaS disruption, increased their stake in Shopify by 18.86% in the last reporting cycle.
Banks are massive, contradictory beasts.
They are putting their money where their mouth isn't. They now hold nearly 34 million shares. That is roughly $4.7 billion of capital. If their analysts are shouting sell because AI is coming, why is their asset management arm buying with both hands? It suggests that they view Shopify as the best-in-class exception to the rule. They are accumulating while scaring the retail investors out of their positions.
Oris, the quant desk is buying based on momentum, while the fundamental analysts are seeing the cliff. But there's another signal driving the sell-off that has nothing to do with Shopify's quality, the poly-market correlation.
Now we're getting esoteric. Prediction markets?
It's not esoteric anymore, it's systemic. IC, the parent company of the New York Stock Exchange, just invested $2 billion into Polymarket. They didn't do that for fun. They did it because prediction markets are reacting faster than the stock market. Look at late January. The odds for a U.S. government shutdown hit 80% on Polymarket.
And that macro fear triggers a liquidity crunch.
Precisely. It's the Polymarket effect. Algorithms are now scraping these probability curves. When the odds of macro instability like a government shutdown spike to 80%, the algos dump high multiple, high-risk assets first. Shopify is a high beta stock. It moves faster than the market. So part of this 8% drop is simply Shopify catching a cold because the macroeconomy sneezed.
I accept that, but that actually strengthens my bull case. If the stock is down because of a polymarket signal regarding a federal budget dispute, that is an external factor. It has nothing to do with Shopify's ability to execute. It has nothing to do with Sidekick or AppLovin. It creates a mispricing. The company is fine. The macro is messy. That is a buying opportunity.
Mispricing or not, price is truth. But let's move from the external macro noise to the signal coming from inside the building. The one that, for me, makes the bull case incredibly difficult to swallow, the insider selling.
Executive compensation is almost entirely stock-based these days. Selling is part of the life cycle. You can't pay a mortgage with RSUs.
This isn't paying a mortgage. This is an exodus. Over the last 90 days, we have seen $14.8 million in net selling. And the net part is important,
because there were zero insider buys. None. Toby Lutke, the CEO, sold nearly 11.7 million.
Toby still holds over 6% of the company. 11 million is a rounding error for him.
Okay, fine. Give Toby a pass. What about the CFO, Jeff Hoffmeister? He sold 4.5 million. The general counsel is selling. The COO is selling. These are the people who have the most intimate view of the Winter 26 numbers before they are released on February 11. If the renaissance is real, if Sidekick is going to change the world, if revenue is about to explode, why are they cashing out at $130? Why not wait 2 weeks for the earnings pop?
Because diversification is prudent, regardless of how bullish you are.
It signals they believe the stock is fully valued or overvalued at these levels. They are taking chips off the table while telling investors to go all in on the future. It's do as I say, not as I sell.
I see the concern, but I'll counter with a different kind of insider signal, a political one, congressional trading. Representative Jonathan L. Jackson has been buying Shopify in October and December of 2025.
You are putting a congressman's trading account up against the CFO of the company?
I'm suggesting that sentiment is diverse, but let's look at why the CFO might be comfortable selling. Perhaps because the company has matured. They aren't just a hypergrowth startup anymore. Look at the B2B features in the Winter 26 release. This is the stuff that doesn't make headlines, but makes money.
You mean the boring back office stuff?
The sticky back office stuff, integrations with Oracle NetSuite, pay by ACH for wholesale transactions. This moves Shopify into the enterprise lane. This is why they are beating Wix. Wix is down 66% because they are exposed to the churn of small coffee shops and side hustles. Shopify is locking in the whales. When you integrate Shopify with a company's NetSuite ERP system, that company isn't leaving. It's too painful to switch. That revenue is safe. That safety justifies a premium multiple.
A premium? Sure, I'll give you 30 times earnings, maybe 40 times for the growth. But 94 times forward earnings? That isn't a premium. That is a hallucination. Even if the enterprise strategy works, that valuation leaves absolutely no room for error. Perfection is priced in. And with the implied volatility at the 81st percentile, the market is sniffing out an imperfection.
Or the market is sniffing out volatility, which is the price of admission for the only e-commerce player effectively weaponizing AI. You can't have exponential growth potential with utility stock stability. If you want safety, buy a bond. If you want to own the infrastructure of the future economy, you buy Shopify and you endure the 8% drops.
We are running up against the clock, so let's bring this to a head. We have the earnings call just around the corner.
February 11, that is the date to circle.
From where I sit, Shopify is a fantastic company with a dangerous stock price. You cannot ignore the divergence between the insider selling and the valuation. When the people running the company are selling and the dark pools are shorting and the PE ratio is near triple digits, I don't care how good the Sidekick AI is. The risk-reward profile is skewed heavily to the downside. The market is looking for a reason to sell, and if that earnings call isn't perfect, they will find it.
And I view that fear as the opportunity. The drop to 131 is noise generated by a macro panic and a sector rotation. The signal is the JP Morgan accumulation. The signal is that Shopify is successfully transitioning from storefronts to agentic commerce. The fundamentals are stronger than the sentiment.
Well, we will find out who is right very soon. The earnings call will be the moment of truth.
Specifically, we need to see if Sidekick adoption is real. If the merchants are using it to build apps and run operations, the thesis holds.
And if they aren't, and if guidance softens even a fraction, that 8% drop on Friday is just the appetizer.
A fascinating setup for the weeks ahead. That does it for this edition of The Debate.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this and leave your comments below. See ya.